Hey guys, it's Rohan here. How are you all doing? So, SEC Chair Gary Gensler is increasingly becoming crypto's most powerful critic, and Wall Street Journal has published a quite interesting piece over here, and I will go through it quickly. But before proceeding, if we have not met before, very welcome to my channel. And in this channel, you will find my analysis and opinion on crypto, macroeconomy, and general investment scenario. Let's start. So, coming back to the Wall Street Journal article over here, Securities and Exchange Commission Chair Gary Gensler is pushing to hold the cryptocurrency firms to the same rules that apply to stocks and bonds rather than write a raft of new regulation for the troubled sector. That puts him at odds with some lawmakers who say the collapse of Sam Bankman-Fried's FTX shows that crypto needs its own set of guidelines, and point out that Mr. Gensler's enforcement strategy moved too slowly to stop FTX from imploding. Mr. Gensler, a veteran regulator nominated by President Biden, hasn't included major crypto regulations among the more than 40 rules he has proposed or finalized since taking office in April 2021. Rather, he has demanded crypto firms comply with the existing SEC requirements for exchanges, broker-dealers, and public companies. So Gensler has added more enforcement attorneys to the SEC's crypto unit and shifted the agency's litigation strategy from focusing on individual tokens to trading platforms that sell cryptocurrencies to investors. His reasoning: there are more than 10,000 cryptocurrencies in existence, but only a handful of major platforms that cater to US investors, and obviously that makes it much easier for him to pursue them. And okay, moving on. The SEC has not written rules and has failed to foresee and prevent disasters in the industry and protect consumers. From Terra Luna to FTX, so this is what was commented by Representative Josh Gottenheimer, said in a hearing last week. And so the FTX fiasco has brought heightened scrutiny of the SEC and its smaller sibling agencies, the CFTC, that is Commodity Futures Trading Commission, which regulates derivatives and is vying for greater jurisdiction over crypto markets. CFTC Chairman Rostin Behnam has said in a hearing on December 1 that FTX collapse showed why his agency should be given authority to oversee markets for the small numbers of cryptocurrencies that SEC has declined to pursue, such as Bitcoin. Mr. Gensler, who led the CFTC under President Barack Obama, has said that he would support Congress giving that agency more powers to regulate such assets. But he said last month that the most recent attempt by lawmakers to write a bill for that purpose was too light touch. The risk, he said, is that new legislation could create loopholes that undermine $100 trillion US stock and bond markets in order to accommodate a crypto market which is less than $1 trillion globally. And that's, to my mind, that pretty much represents his view on crypto. That is, it is $1 trillion. Who cares? Let's focus on stocks and bonds. And because I don't know, probably there's many more things at stake for him for protecting the stocks and bond market and making sure that crypto faces all sorts of resistance in its path. Here is interesting part. Complying with the SEC rules is unappealing for crypto firms. Trading platforms that currently operate as exchanges, brokers, and custodians of assets would have to break up those functions into separate entities to avoid conflict of interest. They would likely have to stop listing all but a handful of tokens that either the SEC agrees are not securities or that have themselves registered with the agency and filed disclosures. Mr. Gensler further said that he moved quickly to limit Americans' access to crypto platforms that offer investors a yield on their deposits. Such platforms look and feel like online banks but don't comply with bank oversight. Less than 5 months after Mr. Gensler took office, SEC notified Coinbase that it would sue the firm if it offered a yield-bearing crypto product to ordinary investors. Coinbase chief executive Brian Armstrong accused the SEC of really sketchy behavior but ultimately had to scuttle the plan. On top of SEC's relentless pursuing crypto firms, the Justice Department, DOJ, is not far behind. So this is coming from another article in Wall Street Journal. Justice Department has sharp eyes on crypto sector, top officials say. And what do they say? A surge in Justice Department resources into cryptocurrency investigations more than a year ago helped prosecutors quickly charge FTX founder Sam Bankman-Fried and augurs a spate of aggressive enforcement ahead, according to the department's second-ranking official. You should expect more. That's what was quoted by Deputy Attorney General Lisa Monaco, who said in an interview to Wall Street Journal. And the Justice Department is building expertise across 93 U.S. Attorney's Office and is coordinating those efforts through a 25-member National Cryptocurrency Enforcement Team. And moving on, this is another very interesting tweet. So first, Stuart Alderoty, he tweeted 2 days back that SEC admits that FTX customer assets were used to bail out BlockFi, where those customer assets funneled to the SEC to make payments on the 100 million SEC BlockFi settlement. Did the SEC bother to conduct any due diligence on the source of those funds? That is, Stuart Alderoty is pretty much accusing that $100 million that was paid as a settlement by BlockFi to the SEC probably came from the FTX customers' assets. And to that tweet, original tweet of Stuart Alderoty, John E. Deaton is replying, is the SEC government, Gary Gensler, going to volunteer to give back the $70 million paid by FTX customer funds to pay down the $100 million settlement BlockFi agreed to the SEC? Or is the bankruptcy trustee for BlockFi or FTX going to issue a clawback of the $70 million? Funny. And in other news, Bitcoin mining hash rate plunges more than 30% amid America's big winter storm. So the weather events has generated a unique set of obstacles for Bitcoin miners in the United States. They rely, that is, miners rely on steady electricity to undertake operations, and protracted power outages have major consequences for their capacity to engage in mining activities. And the United States accounts for at least 37% of Bitcoin's global hash rate. And the hash rate here means, which is a measure of how much computing power is being used to process transactions. Just since Saturday, the hash rate dropped by more than 30%, down to 155 EH from 230 EH per second, according to Coinmetrics data. And ending this video with a pretty positive note, that is this article published in Daily Hodl about Bitcoin price prediction. And here the BTC to defy traditional cycle theory next year with big rally, says top crypto analyst. And the popular crypto analyst says BTC will defy all traditional theories of its market cycle next year. The pseudonymous analyst known as Tech Dev tells his 402,000 Twitter followers that BTC will challenge conventional wisdom, that is, that its price cycles are driven by the halving cycles. So halving cycles are the 4-year intervals when Bitcoin miners' block rewards are cut in half, which many investors believe have been playing a role in putting pressures on the price. TechDev predicts that BTC largely ignores the next halving, likely to happen in mid-2024, and instead turn bullish early next year. So he gives this plot in his Twitter account for the halving cycle of Bitcoin. And he also claims that Bitcoin peaked in April 2021 rather than November, meaning that the bear market is deeper than many realize, and as a result, closer to a turnaround. Let's see. Hope for the best. And that pretty much wraps up this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one.